Today we're going to talk a little bit about all-in-one ETFs, or as the industry calls them, Asset Allocation ETFs. Right now we're looking at the ETF overview from the holding company, BlackRock, for an asset that I hold a lot of in my retirement portfolio, namely XGRO. But what is a multi-asset or an all-in-one ETF, and why are they a really good fit for almost any investor? I think it's probably useful to take a look at an overview produced by the company of their product, and you can find that by going to the literature page and clicking on the product brief over here, which I already have open in this tab. So let's take a quick look here. A couple of interesting points here is that there are actually 5 different all-in-one ETFs, all within the same family. I've been talking a lot about XGRO, but you'll also hear people talking about the other members of the family. And the first question that may come into mind for you is, well, why are there 5 different ETFs? And I think the easiest way to explain that is to take a look at this table here that they've helpfully included to talk about each of the ETFs in turn. The big difference between each of XINC, XCNS, XBAL, XGRO, and XEQT are the percentages of equities in each one of these funds. You may know that equity refers to stocks, whether that's Canadian stocks, US stocks, or international stocks. And each one of these ETFs has a different percentage allocated to stocks in general. The rest of the holdings is called in their nomenclature fixed income, which normally means bonds. Bonds, as you may know, are investment vehicles where you're actually loaning money to somebody and they promise to pay it back. And equity, on the other hand, is an investment in the company's future earnings, so a little bit different. So that's all kind of academic, right? And I picked 80% equity as a comfort factor. Most people would consider the further to the right you get on this chart, the more risky it gets. And risk is a bit of a loaded word. Risk means different things to different people, but in the context of investing, risk implies the variance of return in a given year. What does that mean in plain English? If you've got $1,000 invested in X equity, you probably have for one given year, say a 30% chance of actually losing money in that year. So that doesn't sound so good, and I get it. But I wanted to maybe illustrate, why risk is actually a good thing. And I was just playing with this morning, taking a look at, Google Finance, and which is just google.com/finance, and entering X equity into the mix. And you get a nice pretty chart here, and that's cool. But where it gets interesting is where you can start to compare it to different things. So X equity, as you may know, is the one that's 100% stock. So by rights the riskiest of the ventures. XGRO is what I primarily hold, so we can compare that. And right now we're looking at a day chart, right? So not a huge amount of difference here. Let's add some of the other ones in here just for fun. We've got XBAL and XCNS we can add into it. So let's add XBAL, which is now 60% equity, like so. And then the other stock symbol was XCNS, which is 40% equity. So we're going down in equity as we add more and more to here. We're getting lower down into the equity and less risk as a result. So this is XCNS. And then the last one to add is XINC, which is only 20% equity, the lowest of the offerings here. So, so now we've got them all, right? And it's a bit messy here, but let's blow this up to say a 5-year time period now. And it's a lot less messy now. And you can immediately see the difference in each of them. I guess the first thing you would observe is that there appears to be pretty strong correlation between each of the returns. X equity being at the very top here, with a 5-year return of, what does that say? Well, close to 100%, right? So you've doubled your money in 5 years with X equity. Whereas compared to down here in XINC, the income one, you've returned perhaps 7-8%. Can you actually click it? No, it doesn't look like it. Anyway, more return or more equity means a better return over a 5-year period, right? What you'll notice about XINC, the one with the lowest amount of equity, is that it had a very narrow range of returns. So, you know, in the industry, we call this capital preservation, right? You're not going to lose money. In fact, you did a little bit over the course of a couple of years here, but you're not going to gain a lot either. And so that's an interesting, you know, way to look at it. You know, I've been doing some reading that's suggesting, you know, the only safe percentage in retirement is 100% equity. And that's because the returns are just so superior over time that with any other mix, you actually risk not having enough money through the course of your retirement if you happen to live long. Let's take a look at the maximum here. How far back does it go? All right, so some of these funds didn't exist all the way back, only XGRO and what's this one? XBAL. So this one here is the one I own, XGRO, the yellow one. That's 80% equity. XBAL is 60% equity. And look at that. That's really interesting here. Over the course, let's get rid of some of these other ones just because they're getting in the way. Let's get rid of that. Right, and let's get rid of this one. So yeah, the difference between, you know, 60% and 80% equity is very, very small over the, what's this, 18, 19 years of return. But X equity still, you know, clearly on top with a 68% return versus 52%. You know, in the and what's let's see if we can just roll this back to when they all launched. So 20, we'll go back to the 5-year view, and then I think we can get all three again. Yeah. So, and then it rolls back to what you would expect, right? The 100% equity has the highest return. The 80% equity has the next highest, and the 60% has the next highest, right? So 96% growth, 70% growth versus 46% growth. Anyway, that's a quick overview of, you know, how percentage equity in an all-in-one ETF can really modify your long-range returns, as well as you know, serve you up the amount of risk you're comfortable with. Thanks for watching.